Welcome to Inside the Vault, Enterprise Bank's podcast series where we talk about items of interest to the small business community. Today, we're going to focus on some good information for those clients and friends of the bank that are involved in real estate, either own real estate for their particular small business or invest in real estate. With me today is Vanessa Wallace Clunies with Tangible Property Tax Methods,
Yes.
and I'm going to shorten that for the rest of the episode to TPTM.
Mm-hmm.
Welcome to Inside the Vault, Vanessa.
Thank you for having me.
So before we start talking about your area of expertise in terms of how to help businesses and real estate investors with their tax planning around their real estate holdings, give us a little bit of background on yourself and on TPTM.
Ooh, a background on myself. I am a 30-something-year-old, soon-to-be mother of 3. I lived in Pittsburgh my entire life. Started working with my father, who is a CPA of over 45 years, about 10 years ago. Started a CPA firm with my dad. Worked in specializing in real estate and method changes, and decided to start our own cost segregation firm back in 2021. So we started Tangible Property Tax Methods in 2021 after noticing a consistent trend with cost seg companies not fully understanding the right way to qualify or classify different components of a building. We use the tax code for this, and we noticed a lot of errors in other cost segregation companies. And so my father and I decided, why not start our own? And so we've been doing that since July of 2021.
Nice. And you're based locally here in Pittsburgh?
We are. I am based here in Pittsburgh. We have an office in Naples, Florida, and our engineers are actually located in Louisiana.
Okay.
We have sales reps all around the country that sell for us, so we are nationwide. We do studies outside of the United States and Mexico. We have actually also analyzed something in Nicaragua.
Interesting.
Yes, anything as long as it's a tax payer, U.S. taxpayer.
Okay, so let's talk about kind of the topic that I think a lot of folks in the real estate world have heard about, which is cost segregation. So, at its very core, what are the basic principles of cost segregation and how that applies to taxation?
Well, cost segregation is an IRS-approved way to help accelerate depreciation. The IRS states that you can take a building, you depreciate it over 27 and a half or 39 years, depending on the use of the property. 27 and a half is residential, 39 is commercial, and you're allowed to break it down further into 5 and 15-year components to help provide a tax benefit in the current year of implementation of cost segregation. Now, the IRS states it must be an engineering and factual-based study. The CPA can't just determine, hey, I think you have $20,000 of 5-year property, and your landscaping looks to be about $80,000. So that's what we're going to put on the depreciation
Not
schedule.
that simple.
Not that simple at all. It must be engineering and factual based.
So, what kind of the history of the tax code or the laws around cost segregation?
Well, back in the 80s, the IRS stated that you can go ahead and separate it. There was a court case that allowed, that stated that you can go ahead and separate it out. Forgive me, I don't have the direct IRS code off the top of my head. If my father was here, he'd be able to provide that. But
so this applies to you mentioned 2 of the different standard depreciation periods. So can cost segregation studies and analysis be done on both commercial and residential properties?
Absolutely. It can be done on any kind of property, commercial, residential, a warehouse, industrial. Different buildings yield different percentages for the 5 and 15 year based off of their components. If you have a multi-unit apartment building, generally you're going to be looking at a higher 5 and 15% because of the components. You have a lot more kitchen cabinets, a lot of cabinetry. You could potentially have wood flooring. That will yield a higher 5 and 15%. If you have a warehouse or an industrial space that's pretty much a shell of concrete and steel, you're not going to have a significant benefit as you would, office or commercial or residential property.
So what are the property types, or let's say business types within those properties that have the most advantages associated with doing this analysis and resetting their depreciation schedules?
I typically love to say multi-unit residential properties are going to have a higher 5 and 15 year. Some commercial properties, medical facilities, depending on how it is split up between the facility and the improvements. Sometimes you will have a medical facility or a medical office that you have one person that owns the building, and then you have a doctor who leases. And a lot of those components of the building and the office itself will be under leasehold improvements. That might not have a very big 5 and 15 year for the building owner. But if the building owner owns all of the components in the medical facility, that could also yield a very high percentage for 5 and 15 year.
So what we're basically coming back to the kind of the accounting methodology or theory here, what we're talking about is, not only what can be depreciated, but over what life based on where it falls.
Correct.
And then there's also, which probably gets into a little more of a more broad topic that we're going to talk about, what you can expense versus what you can capitalize.
Yes, correct. For cost segregation, different components of a building have different class lives. The IRS is very clear on what you can qualify as 5-year property, 7-year property, 15-year property, depending on the class life, the use. And then there's also different components as well. If you have a property who's focused in manufacturing, different manufacturing can also qualify for accelerated depreciation because of the purpose and the purpose of the building.
So let's talk about kind of the process. That might give some of our viewers and listeners kind of more insight. So what are the steps in the process for a cost seg analysis, and how you approach it with the property owner?
Well, for my company, what we do is somebody will reach out to us and ask for a cost segregation analysis. We ask for basic bits of information to provide that analysis for them. It's always a property address, a cost basis, which could be a purchase price net minus land, or if they have a depreciation schedule, we will request that. We need the date placed in service and the use of the building. For instance, and this is important because if you have a single family home, and it looks to be a long-term residential, but it's actually an Airbnb, it's a 39-year class life. It's not 27
Then
and a
it
half.
falls into commercial
Correct.
realm.
It falls
based
into
on the
hotel.
IRS classification.
Yes, that is correct. So we'll ask for those bits of information. If any improvements were done after it was placed into service, we'll also ask about that. And just like a quick little detail of the improvements done, just so that we can help provide a clear understanding or an accurate estimate on what we're looking at. My engineers look at every single property we get. They'll assess it and provide a percentage for 5 and 15 year. We put it into our little calculator, send it back to the client with details. Hey, this is what you're looking at for additional depreciation. This is going to be your net tax benefit or assumed tax benefit, depending on the tax rate that we will either do 37% or we will ask the CPA or client what they want us to use, and we'll send it back to them.
So this available for all property types, you said.
Yes.
But to get the tax benefits, obviously it has to be a building that you're depreciating. So people aren't going to use this for their personal residence.
No, absolutely.
But they're going to use it for investment real estate, whether that be
Correct.
residential or commercial, or if they're owner occupants in a commercial property, they're going to use it.
That is correct. Yes. So if you cannot use it for your personal residential home.
Right.
If you have a second home that you also vacate to or you use leisurely and don't rent it out, that's also not eligible. It has to be something that you're using for a business or for a rental purpose. So short-term residential or short-term rental for an Airbnb, that would qualify. Long-term rental.
Which I would imagine that whole emerging genre of vacation homes Airbnbs, VRBOs, all that has opened up a whole new market for using this
does.
type of analysis and process to save taxes.
Absolutely, because what the IRS considers a commercial property, an Airbnb, is anything that is rented out on average less than a month.
Okay.
So for a week, 2 weeks, as long as it is under that month threshold,
Mm-hmm.
you technically qualify as a hotel, or you can qualify as a hotel in the eyes of the IRS. We like to recommend that if you do have an Airbnb, always offer substantial services, amenities, extra cleaning. I had somebody call me and ask me if their MOOC, which is, I guess, is like an electronic golf cart,
Okay.
in their Florida house would qualify as a substantial amenity. And I said, yes, definitely. But instances like that. And that qualifies them for this property to go on a Schedule C, which would be a business, rather than a Schedule E. And that's important because, if an individual has a W-2 job and they're not technically a real estate professional, they can
Right.
still take the benefit of doing cost segregation on this property.
So, Vanessa, you mentioned the term real estate professional.
Yes.
So, how does the IRS define what a real estate professional is?
There is a whole bunch of qualifications that the IRS states, but the main one is that you meet the hour requirement and the process to be a real estate professional. That includes how much you are involved in being a real estate professional. This can deal with invoicing, managing the properties, scheduling, doing the leases. It depends on the type of property. If you have a commercial property with office tenants, it could be related to those invoices, any kind of maintenance, scheduling the maintenance for that. As long as you meet an hourly requirement from the IRS, you should be okay. Unless you're a doctor with a W-2 and can't meet that requirement. So then it's going to be a little bit difficult to prove.
Right. So, if I'm let's say a hobbyist that I have one rental property on the other side of town, but I have a full-time day job and it's a minimal amount of work, I'm not going to qualify as a real estate professional.
You might not qualify if you have a spouse that qualifies or participates in the rental properties, managing the properties. That could be an avenue you could research and see if it would be possible for your spouse to qualify. Then that would work.
And then what are the advantages, of being a real estate professional vis-a-vis, the tax benefits?
If you're not a real estate professional, have a W-2 job, it's going to be passive.
Okay.
So there are limitations on what you can take with passive income and passive offsets. If you're a real estate professional, there is no limitation. You can go ahead and apply it to your taxable income. But like I said, definitely want to qualify. And if you have the hours, or if your spouse has the hours, I always recommend that you have them documented in case the IRS says, prove it. Here you go.
Well, the bank has a lot of clients that
Yeah.
that's their business,
Yeah.
is investment real estate.
Then it shouldn't be a problem for individuals.
So what are some, getting back to cost segregation, so, what are some examples of type of savings that, a client can experience if they do this right?
That's a great question. We have done thousands, tens of thousands of studies, but a couple ones that stick up out of the top of my head. We have an individual that owned property in Las Vegas, Nevada, and Utah, about 10 properties in total. The net negative adjustment, since they were all on the depreciation schedule, was $1.5 million. So depending on the type of building it is, depending on the type of property you have, it can range from a little bit of benefit to a really significant number. If you have a higher end property house, that's probably going to yield a little bit higher because you have nicer fixtures, nicer components in the property. If you have a small single family home, you might not have that much benefit.
So I'm assuming one of the advantages of what TPTM does is kind of look at the arbitrage between the cost of going
Yes.
through the process and the analysis versus the end tax benefit. Right?
Yes. And we have software as well, too, that kind of analyzes every single component of the building that, appliances, for instance. If you have Wolf appliances in a property, it's going to have a higher value, obviously, than something maybe just a General Electric stove. So we make sure that we apply the right amount to the appliances as well, so that our studies are incredibly accurate and really showcases the difference of benefit.
Yeah. So one of the challenges on my side of the table, being a small business lender, is getting, having in my case, a borrower with good record keeping.
Mm-hmm.
So I think probably in your world, the property owner needs to have good record keeping, particularly to determine what their initial cost basis is or was for
Mm-hmm.
these different components.
Mm-hmm.
So what are some, for a real estate owner that's interested in looking at this from a tax advantage perspective, what types of record keeping should they make sure that they're, obtaining or keeping when it comes time to do an analysis?
Well, if they have a lot of properties, if they are recent purchases, always a settlement statement, appraisal. If they have owned these properties for a long period of time and it's on their depreciation schedule, that's all we need in order to give an initial assessment. If they decide to engage with us, we will ask for appraisal. If they have blueprints, if it's a new build, or if they've done significant improvements, we'll ask for those improvement details, as well as an AIA document that kind of breaks down the costs.
Okay.
So there's a bunch of different things depending on the length of ownership, what they did to the property, that the property owner should keep track of, but always have a depreciation schedule. And I'm not talking about the Form 4562, talking about a detailed federal depreciation schedule that lists out the asset, the date placed into service, the cost basis, depreciation, all that good stuff.
So let's kind of fast forward towards the end of the process. So you do your analysis and you determine, reset the depreciation schedule based on, what types of allocations you make to different types of improvements
Yes.
or components of the property. Then how does that work vis-a-vis the IRS?
So the IRS states you're not allowed to change a depreciation schedule without filing a Form 3115, and that is a change in accounting method. For all of our work, it is an automatic method change. So you submit it to the IRS, they kind of say, yeah, cool, it works. We see a lot of these. But it's a DCN 7. They have to file, and we do this as part of our service. We prepare the calculations for the CPA. We prepare, this is what the asset used to be with our cost segregation. This is what the split should be between this 27.5 or 39 year, 5 and 15 year. And this is going to be your deduction on your tax return.
Now, is there any look back to how it's been depreciated prior to you all doing the study?
Not always, no, not necessarily. All 3115s must be filed in the current year on not on a late filing or an amended return. So it has to be current filing. If you provided it an extension, say it's September 3rd, and you're on extension, you can still file a 3115 as long as it's ahead of the 9/15 or 10/15 deadline.
Gotcha.
There is no, look back or risk for audit because the
Right.
IRS receives a lot of 3115s. As long as it is prepared and filed properly, there should not be any concern.
Okay. So let's kind of jump into kind of the more general topic. There's not just, cost segregation as a way to reduce taxes, but there's rules around how property is supposed to be classified in the first place.
Exactly.
And I think your industry terminology is tangible property regulations.
Oh,
Right?
the TPRs. Let me get situated for this one.
So I know when we were talking offline, you said, people get this wrong all the time.
People, they don't get it. Yeah, they don't. Well, first off, they don't usually know about it. And so they just kind of go into it blindly, or a CPA just assumes that they know key components of the TPRs and they just brush it off. Or they don't have the time to spend to actually research and understand the tangible property regulations in order to implement it properly on a client's tax return.
And we're talking about probably the primary issue there is capitalization versus expensing.
Correct. So cost segregation is on the building and its components, separating it out in itself to provide additional or accelerated depreciation. The tangible property regulations are focused on every work effort done on a property after it was placed into service. And this can include change of flooring, tenant improvements. You have a commercial property and a tenant moved out. You need to refurbish the space for a new tenant. That can also be considered an expenditure. HVAC unit that you need to replace. Anything that was done after the building was placed into service and that is on that depreciation schedule are items that we look at.
So, my understanding is that there are basically buckets of types of expenditures where they fit, and there are certain tests that need to be met to
Yes.
essentially comply.
Yeah,
with
there
the
are
regulations.
The IRS states that there are 16 RABI rules:
RABI.
restoration,
Okay.
adaptation, betterment, and improvement.
Okay.
I think my father coined the term RABI rules. But general, if you have an expenditure and it meets one of those requirements, or it matches anything under the restoration, adaptation, betterment, improvement, it can be considered a repair and maintenance and does not need to be capitalized. So there's a lot of wiggle room there, but there's also a lot of detailed rules on what qualifies. There's a percentage of the overall unit of property that needs to be taken into consideration whenever you have an expenditure. And if it meets one of those requirements, then repair and maintenance. So what I mean by that is if you have an asset on your depreciation schedule and we look at it and say, hey, this should have been qualified as repair and maintenance, that's something that we would take a look at and we would eliminate from that depreciation schedule. So you would have what is remaining on that depreciable life is going to be a deduction on your tax return.
But you're going to be able to take expense, essentially, and I'm assuming in the period that
the current year
that you make that adjustment.
Yeah, and it's not just for you pick and choose assets. It is you have to analyze everything that's on that depreciation schedule for anything that was improperly classified as a capitalizable event and something that needs to be considered as repair and maintenance. Now, you do this one time on a depreciation schedule to clean the depreciation schedule up. You still file a 3115, different designated change number.
Okay.
The IRS has about, hundreds of different designated change numbers for the 3115. They all serve a different purpose. For the TPRs, it's called 184, Capitalization of Repairs and Maintenance. And we will go and file it, clean up that depreciation schedule. And then next year you start with a very brief depreciation schedule. Only the assets that need to remain on that schedule that need to remain capitalized per the IRS. Excuse me. Anything moving forward. So you go into 2026 and you have a list of items that you did on a building or that you have to do for a building. Then you analyze those in the current year and determine if it should be repairs and maintenance or if it needs to be capitalized. But you don't need to file another 3115.
Okay. So, one of the biggest challenges, we do a lot of investment real estate financing. One of the biggest challenges is we'll see wild swings in expense, repairs and maintenance expense, particularly before the accountant gets a hold of it at the end of the year to do the tax return. And then typically what happens is a portion of that gets capitalized and then a portion actually stays in repairs and maintenance. So it's kind of hard to really kind of normalize a normal, repairs and maintenance expense load for a particular real estate investor or business that owns real property. So I'm assuming, these regulations, if you follow them, you're pretty much following the tax rules
Yes,
for when the ultimate tax return is prepared.
that's correct. But there's also an instance where if a client has different book and tax, this only applies to federal taxes. So this does not apply to book. So exactly, if they need to, we have a lot of senior living facilities, individuals that have nursing homes. Some states have different requirements on showing what they put into the property, and they give them benefit for what they spend on that property. That doesn't affect, the tangible property regulations does not affect what they do on the book, just on the taxes. And so that could be significant for different owners for, banking purposes, state reporting purposes. It does not have to match up.
Right. So let's talk about the current legislative political climate with the big, beautiful bill. Um, how's that going to impact either positively or negatively the benefits of whether it's cost seg or expense versus capitalization? What's the latest and greatest?
So
'Cause a lot has changed.
are we
from my
calling it the
understanding.
OBBB, the BBB, whichever one that is? It significantly applies to assets placed into service and when they're placed into service for bonus. So if you purchased a property and you placed it into service January 21st, 2025, any components of that building that you do a cost segregation for, the 5 and 15-year components qualify for 100% bonus. Prior years, if you purchased the building January 6th and you put it into service January 6th, 2025.
Like I used January 6th.
I didn't even think about that, but thank you for calling me out. That would only qualify, let's see, you did 100% in 2022, 80% in 2023, 60% in 2024. So you're down to 40% for those first few weeks of 2025. You place that building into service between January 1, 2025 and January 19th, 2025. You have 60% bonus on those 5 and 15-year assets. So it depends on, as long as you purchase a property after January 20th and put it into service after that date, you're eligible for 100% bonus. If you have a property that you have owned since 2023 and it's been in service, the new bill doesn't affect you.
Gotcha.
Your building was placed into service in 23. The tax laws for the tax year 23 apply to that building. You are only allowed to take 80% bonus.
Gotcha.
The tangible property regulations, it doesn't affect it. These are removing assets that were improperly classified.
Yeah.
So it doesn't apply.
So the tangible property regulations, I mean, how dangerous is it for a business to do it right, to not do it right?
Huge. So this is an IRS mandatory regulation. And just a quick little background on the TPRs. It took them about 60 years for them to put it into regulation. There were different changes, there were different edits, there were different, oh, hey, what about this? Oh, wait, no, we're not done yet. We're not going to actually release anything until 2013, 2014. And then since then, the IRS states you must implement the TPRs on your property in all expenditures. If you were to get audited and the IRS agent comes in and says, hey, looking at your 20-page depreciation schedule, you are essentially forging your depreciation schedule by having these assets improperly on your depreciation schedule and taking this benefit that should never have been a benefit. These are repairs and maintenance. The IRS can determine that you are no longer allowed to use the net remaining depreciable basis of those improperly classified assets. It's called the use it or lose it rule. So you use the TPRs and you take that benefit and you apply it properly to your return, or you lose all potential benefit.
Wow. So.
And I have an example, actually.
Do tell.
We had a client who was under IRS audit. Maybe didn't always make the best decisions with stuff, but he was definitely under a microscope with the IRS. He owned some significant bits of property throughout the United States. And his CPA came up to us and said, hey, he's under audit. Can you take a look at his depreciation schedule? Our immediate question was, have they asked for the real estate or the depreciation schedule? They said no. We said, okay, give us what we can and let's see what we can do. We went in and we filed 3115s with zeros just as a safekeeping for this individual, provided it to the agent. She went back and was like, I have no idea what this is. Went back 3 weeks later, went to classes on the TPRs, had seminars, talked to her superiors, came back and sat us down and said, I had no idea what these were. And I did all of this stuff. And now that I know, you are protected from audit on your real estate portion and the depreciation. And if you did not provide me with this and I had gone back and taken classes on the TPRs, you would have lost anything, all depreciable basis on these assets. We saved this individual $280 million. He would have lost $280 million of benefit.
That's insane.
It's hard to
Yeah.
comprehend sometimes those numbers.
Right.
But there are individuals out there with significant real estate, hotels, large multi-unit residential properties, large commercial properties. This can add up.
So, at what property, let's say, I don't know what your metrics are. At what scale should a real estate owner or investor really start paying attention?
If they've owned this property for a long period of time and they have a depreciation schedule with multiple line items, particularly 27.5 or 39-year property, they need to start paying attention to what is on that depreciation schedule and what needs to be cleaned up.
And with regard to the cost segregation, is there kind of a point there where, is it property value, is it the property cost and residual costs, or?
We like to say that, typically anything under $500,000 won't yield a significant benefit, but we'll analyze anything that we have in front of us and we'll advise a client or a property owner, hey, you have a small cost basis, you're not going to get much 5 and 15-year benefit.
Right.
Compared to our cost, it's not going to be worth it for you to do a cost segregation study. But
how long, Vanessa, does the process typically take on the cost segregation?
That's a great question. We're actually pretty efficient for for what we do. In tax season, it will take a little bit longer, maybe about 4 to 6 weeks to turn around a study. But as long as we have all of the data in, no more than 3 to 4 weeks. And that includes like a site visit. We do have an inspection company that takes a look at every single property we study, takes pictures of every component of the building. We always ask for appraisal, blueprints if available, confirmation of cost basis. But as soon as we have that information, 3 to 4 weeks max. But we've turned stuff around in less than 2 weeks before.
So how does a real estate owner or a real estate investor learn more about TPTM and or just these regulations and or the benefits of cost segregation? What are some good resources? Plus, how can they take advantage of the services that your firm provides?
Well, our website has some good blogs on cost segregation, tangible property regulations. They can always go to taxmethodexperts.com and learn a little bit more about TPTM, our services, read some blogs. But they can also do some other research on cost segregation in the IRS. It is a kind of a commodity. There's a lot of CPA firms that offer it. There are cost segregation firms that offer it. So there's a lot of education on cost segregation that's on the internet. For the tangible property regulations, we are the experts on this. I'll toot my own horn, but it's definitely worth it to reach out to us to get a little bit more information. If they Google my father, Eric P. Wallace, you'll see a whole bunch of details on him as well as the tangible property regulations. There's not that much information on there unless they want to read the IRS section, and I don't recommend
recommend reading the tax code.
That would be about 500 to 1,000 hours if they really wanted to get involved in it.
So, to wrap up, so what is your advice for real estate owners in both of these realms?
If you have a property and you have not implemented cost segregation, this is definitely something you need to look into, especially if you're going to be holding on to the property long term. You are always subject to recapture if you sell a building after implementing cost segregation for that 5 and 15 year. But if you're going to hold on to a property long term, there's no reason why you shouldn't take the benefit up front and get that additional depreciation or that accelerated depreciation to help offset any kind of income you have.
And you all, I'm assuming, just do a consultation up front.
Oh, absolutely.
With the client.
All of our analyses are free. So anything that they need, if they want a cost segregation analysis, we turn that around within 48 hours. Our engineers take a look at it. We send it back to them. with a detailed, hey, this is what we project.
Right.
And also, here's our quote for services. If you want to sign up with us, just let me know. For tangible property regulations, it's also a fairly simple process. If they want us to analyze their depreciation schedule for any kind of TPR benefit, depreciation schedule, and a property address, they get that over to us.
Either for a benefit or to get it fixed.
Yeah,
right.
exactly. Like, hey, this is what we're projecting, or hey, good job, buddy. Your CPA knows what they're doing.
Yeah.
And, that's usually 10% of the time, maybe less. But we'll take a look at it and set up a meeting. I have no problem getting on a call with somebody for 30 minutes, explaining them in a little bit more detail, the TPRs.
Excellent information, Vanessa. For our viewers and listeners, this could make a significant impact on your business in a positive way from a tax savings and cash flow perspective. You heard Vanessa say with some of the new rules, particularly for properties put into service now and going forward under the new tax legislation, probably even a bigger impact.
Yes, absolutely.
Than it has been historically. Thank you very much for the info. Thank you very much for the time. For those of you that have any questions or ideas for future episodes, you can email us at insidethevault@enterprisebankpgh.com. You can check us out on audio format and all the major podcast platforms and in video format on YouTube. Thank you for watching or listening.